Greetings to you, and welcome to our final panel discussion here at Acton University Online. We're so glad that you could join us. My name is Stephen Barrows, and I'm the Managing Director of Programs here at the Acton Institute, and I'm delighted to welcome two distinguished panelists. Don't forget that throughout this conversation, you're free, and we encourage you to submit your questions in the chat room space online, and I'll seek to share some of those questions with our panelists during the course of our conversation. So without further ado, let me introduce to you our distinguished panelists. First, Dr. Daniel Lacalle is an economist, fund manager, and best-selling author. A professor of global economy at IE Business School in Madrid, he is a regular contributor to CNBC, Bloomberg TV, BBC, Seeking Alpha, Business Insider, and the Epoch Times. Ranked as one of the top 20 most influential economists in the world in 2016 and 2017 by Richtopia, he serves as a member of the advisory board of the Rafael del Pino Foundation. So we welcome Dr. Lacalle.
Thank you very much.
Next, I'd like to also introduce and welcome Dr. John Taylor, who is the Raymond Professor of Economics at Stanford University and George P. Shultz Senior Fellow at Stanford's Hoover Institution. He was Treasury Undersecretary for International Affairs from 2001 to 2005, where he was responsible for currency markets, trade and financial services, foreign investment, international debt and development, and oversight of the International Monetary Fund and World Bank. So welcome, Dr. Taylor.
Thank you.
So let me frame sort of the conversation for our audience today. And we know that we're going through this urgent situation, this crisis with the global pandemic, and we've had interventions by both fiscal policy and monetary policy. And the central bank has done something here in the United States I think is quite remarkable. Back in March, the Federal Reserve stated that it was committed to using its full range of tools to support households, businesses, and the U.S. economy overall in this challenging times. Of course, that those tools include everything from purchasing government securities to mortgage-backed securities, and then intervening in a variety of credit markets. And then on April, they went further and said that they were ready to provide up to $2.3 trillion in loans to support the economy. And then most recently, they're on the verge of implementing the so-called Main Street lending program. So to begin, and perhaps I'll begin with you, Daniel, I understand, and it's certainly urgent to maintain liquidity in the marketplace, just to keep ordinary markets functioning. And yet at the same time, we know the kinds of interventions that are happening here do have long-run risks. And so what is your perspective on these risks in the interventions by the central bank in this regard?
Yes, thank you very much, and thanks for having me in this fantastic conversation. I think that the biggest risk is that the extent of the support that the Federal Reserve provides makes the economy drown in a sea of liquidity. And let me explain what has happened, for example, in the Eurozone or in Japan, is that the liquidity injections go fundamentally to those that do not need it, which are governments that may finance themselves easily in an environment in which there's plenty of demand for sovereign bonds, and to large corporations that already had challenges of earnings and cash flows in 2019 and 2018, whilst at the same time becoming the main beneficiaries of these purchase programs. So what we saw, for example, in the Eurozone in the past, examples of liquidity injections, was that the main beneficiaries became the government spending, for sure, but fundamentally in the asset purchase programs, those companies like autos that were not necessarily in need. So one of the risks is that such massive injections of liquidity do not reach the small, medium enterprises, which are the ones that are suffering the most, the ones that don't have access to either credit or that don't have tangible assets. Those are to me, big risks, because they're also the companies and the businesses that generate the highest and quickest employment. Therefore, the risk of stagnation is not small. And we're seeing, for example, that according to the Bank of International Settlements, the percentage of zombie companies are those that are unable to cover their interest expenses with operating profits, has risen to almost 20% of the quoted companies. While at the same time, the delinquencies on credit cards and the bankruptcies obviously are rising. So that is one of the challenges. The challenge is, how do you get the mechanism of transmission of monetary policy to actually the sectors and the businesses that actually need it in this environment?
So that's interesting. So poorly targeted, it sounds like, and end up using a hatchet instead of a scalpel to try to deal with the problems that we face in the economy. So that I appreciate that response, Daniel. How about you, John? Anything you'd like to elaborate on, either regard to in response to Daniel or other risks, perhaps?
Well, yeah, I think the biggest risk is they're doing too many things. You mentioned the Main Street lending program. That's quite beyond the normal scope for a central bank. They already have interest rates close to zero. They're thinking about even having pegged the 10-year, the 5-year rate, and of course the quantitative easing. That means the large purchases of securities. So it's quite a bit. I think in a way the risk is it moves away from a more rules-based policy that's worked pretty well in the past, and including many people at the Fed have been advocating recently. So that's the risk I see. I think at this point, there's efforts to provide a lot of liquidity, and of course, those efforts can be too much liquidity if we're not careful. I think what I like about the philosophy compared to much of the actions is it's trying to keep markets open. So many of the actions have been to close markets, shelter in place, et cetera. And these are trying to keep markets open. The risk is they go too far and it's hard to get back. You have a central bank that's unlike central banks that's worked in the past.
So that's interesting. You're trying to keep markets open in contrast to some of the government dictates, which of course in a pandemic environment are certainly understandable when you want to try to suppress some of the spread of the disease. And yet at the same time, it seems like, as you mentioned, the rule-based approach of the central bank, it sounds like in this case, they're effectively trying to collaborate and cooperate with the fiscal policy actions such as the CARES Act, which is effectively printing fiat paychecks for a period of time, and then correspondingly a fiat monetary policy. So do you think that the collaboration of those two fiscal and monetary policies that are moved in the same direction, are they exacerbating the risk, or is it understandable given the circumstances? How about you, Daniel?
I definitely think that there's a significant risk because ultimately government spending, we all understand that government spending is going to rise in a pandemic and that there's a number of elements that are going to drive deficits higher. However, the temptation to consistently and constantly monetize deficit spending hides as well a lot of inefficiencies. And we cannot just think of monetary policy as something that is going to avoid governments from doing the administrative work and the planning that they have to do in order to keep as close to the budget as possible. So that is a huge challenge to me, because what we saw, for example, and I come back to the example of the Eurozone, because I think that the Federal Reserve is getting dangerously close to what the ECB is doing, is that a policy that was implemented to allow governments to gain some time in order to implement structural reforms and get healthier, what has become is a policy that actually is an excuse for governments not to implement the structural reforms. And that's a very dangerous path to, once you've crossed it, it's very difficult to come back, because it's not easy to go back to a government that has a deficit of either, I don't know, a couple of trillion, 3 trillion, and to say you have to go back to 120, or to half a trillion even.
Certainly. So with those structural reforms, and just in more broadly speaking, having the government be able to have space for markets to flourish more, John, what would you expect the Federal Reserve to do to help facilitate the opening of markets? Are there things different from what they're already doing? Is it too ad hoc? How might the Federal Reserve or central bank approach this to encourage markets to grow?
I think one thing they could do is outline where they're going. One of the most important things we've learned about monetary policy over years is that you need to describe a little bit what's happening. So there's very little of that. There's maybe expect rates to be low, near zero for a long time. There's even talks about rates being negative, as in Europe and Japan. I think some clarity would help. It doesn't have to be outlined specifically, but a little bit of how this is eventually going to be unwound. And remember, we did a lot of this extra kind of policy after the great financial crisis, global financial crisis, and it was in the process of being unwound, and then of course it's been reversed. So I think that that strategy, description of what's happened, when interest rates will rise, what it will be like, will there be a policy rule? There's a lot of things that can be laid out to more explicit. And I just mention one thing about the fiscal side. But yes, as Daniel said, the deficit has gone from $1 trillion in the U.S. to $3 trillion. And I think you could also think about how this is going to be undone. No one's talking about it. It would be beneficial to say this is not the way it's going to be forever. To outline some economic strategies, sensible strategies, so eventually we can go back to high growth again. We want to get to high growth to help people that are being hurt by this crisis.
Certainly, when you talk about having it be undone and trying to, bring back the liquidity when the time is right, one of the things it seems that is that the Fed has almost tied its hands in that regard. I mean, they have spent so much effort trying to facilitate the issuing of new debt to deal with the crisis. Do you think that the options are limited? Because let's face it, after the Great Recession, they did start to unwind things. But I think interest rates only got up to roughly maybe 2.5% in that arena, and it strikes me that their hands are tied in many regards. What do you think, Daniel? Do you think central banks are tying their hands?
I definitely think that at least the effectiveness of the tools is definitely diminishing, and the diminishing returns of monetary policy are pretty evident, even in asset classes. You see, for example, yes, equities and bonds are reacting to monetary policy, but not globally. If you look at, for example, European markets did not work that way, and it did not improve, for example, the spread between high yield bonds and small and medium enterprise lending. So there's the mechanism of transmission doesn't improve when the biggest amount of that liquidity goes to government spending, particularly current government spending. There are tools that they're talking about, like yield curve control, the Japanese way, etc. But we know that in a country like Japan, with all of the challenges, demographic, etc., but also monetary challenges that it has not worked particularly well in terms of delivering the key elements that will drive the economy further. That is to look for higher growth, which is what John was mentioning right now. Is that the risk of zombification of the economy is very, very high when money creation, which is obviously not neutral. Money creation massively benefits the first recipients of money, is going to government spending and is going to large entities that were already, in any case, heavy in debt. So I think that is the big risk, because what we know as well is that from the previous crisis, we tend to get out of crisis with lower productivity growth, with lower levels of growth than the previous exit, and also with lower levels of job creation and investment. And we should be aiming at the opposite. So I think it's what John just said about a good way of avoiding the perverse incentives that unquestionably expansionary monetary policy has, is to have very, very clear guidance and very clear communication. And I think that the Fed was very good about that, warning markets about constantly buying the dip, going very aggressively into high yield, et cetera, by giving a clear time frame of improvement. Right now, we're on an uncharted territory. The ECB doesn't know when it is going to even think of changing its monetary policy. And that creates that perverse incentive of basically just not doing what monetary policy is supposed to do, which was to help markets return to investment growth and job creation.
Yes, absolutely. And that's so critical, because after all, to the extent that there's not actual productive activity occurring, whether it be through government mandate for lockdowns or what have you, we can't pretend as if it is and continue to go in that direction. So if we are going to facilitate those markets and do so in such a way that you've described, where the Fed sort of announces where it's headed and also make it rule-based, John, what kinds of things would you suggest the Fed ought to be doing to announce where it's headed on the basis of certain rules or conditions?
I think one thing would be to just emphasize that before this crisis happened, it was going back to a good policy. They had publishing how the rates would change based on rules. They had people advocating it. The Monetary Policy Report for a couple or 3 years in a row had whole sections on this. And the economy was doing better in 2017, 2018, until this mess has hit it drastically. So I think that's the key. There's some technical things which the Fed is thinking about. For example, the rates will be low for a while. They've said that, but when will they come up and what will it be based on? Well, there's strategies, there's rules, there's formulas, and informal ways to talk about it. And I think they can do that. There's actually a very good research work done a long time ago at the Fed by John Williams, who's now president of the New York Fed, about a strategy to come back out of situations like this. So I think they should think about that and articulate it as best they can. You know, it's not rocket science, but they can indicate to the markets to some extent what's next.
Exactly. That's interesting. I want to shift gears just a little bit here and mention that, John, you wrote an authored a prize-winning book entitled First Principles, 5 Keys to Restoring America's Prosperity. And Daniel, you just published the widely praised Freedom or Equality, the Key to Prosperity Through Social Capitalism. And in each of those books, you both identify the dangers of crony capitalism and regulatory capture. And it strikes me, when we're going through periods where we have an enormous fiscal expansionary policy that's been implemented and a corresponding monetary intervention, as we've seen, we open up the door for additional crony capitalism risk. Any comments on what we might, how we might be able to avoid that, or how the Federal Reserve or central banks might help avoid a crony capitalism free-for-all?
Well, I think that if we look at what we have just been mentioning, and having a rules-based and very, very targeted policy that doesn't just inject liquidity into the usual suspects, the super large companies or sectors that are close to government, that in itself is quite positive. I think that's where the details of monetary policy can improve, and being very, very clear about the path to coming back to normalization. We forgot the word normalization. It doesn't appear in the minutes of the Federal Reserve anymore, or in the minutes of the ECB or the Bank of Japan. So I think that is very important, because what we do have is the examples of other economies. And I think that the great thing that the United States has is that it's a much more dynamic and a less banking system financed real economy that allows the economy to grow faster once it recovers and create jobs faster. But if monetary policy starts to mirror too close to what the Eurozone is doing and what the Bank of Japan is doing, what you end up getting is that the benefits that the economy got from a rapidly developing financing system for the real economy, and a diverse one, ends up being lost in the zombification of large corporations and government spending. So I think that there's a lot that they can do in terms of communication and in terms of guidance, particularly to avoid this very dangerous thing that happens in markets as we speak, which is that the worse the data, the better, because some market participants expect further monetary injections when macro data is negative, and they decide to buy the riskier assets. That creates bubbles, and that is something, paying attention to financial assets is something that they should do, and I think that is being asked a few times to Mr. Powell, and I think that they should start doing it quite rapidly. Yeah.
Yes, thank you, Daniel. And John, I see you nodding your head. Would you like to elaborate?
Well, first of all, I think your question is very good. How do we ensure this economic freedom continues and we don't have a rollback? I think there is a concern about a rollback because so many of the interventions in the shelter in place, et cetera, social distancing have been mandated in the US by state governments or even the federal government. So in a way, we're going the other direction now, and that's unfortunate because I think what we're learning is that the markets, and I'll call it economic freedom, the principles that you mentioned, are really what's going to make a difference. So I would like to see, just for example, telemedicine is exploding in the US, probably more broadly than I know. That's a sign of freedom, different ways to conduct your policy. Online sales, videos, things like we're doing right now are exploding. The school education is changing as we speak. And so in many things, we don't want to thwart that. And there are government decrees. Occupational licensing is in the US, and there's more regulations in other countries. In California, you have something called AB5, which is restricting types of employment. So this is a very good time to relinquish some of these controls. And I think if we're also seeing a lot of things about how the economy works. Certain people are being hurt bad by this. It's illustrating some things that we need to improve, and I hope we can do that too.
Absolutely. And frankly, by way of personal experience, I've watched my wife at home, who she happens to be a physician, has been able to take advantage of this. Rolling back of some of the very restrictive HIPAA regulations and being a bit more open to the use of telemedicine, where you can see that technology has really helped open up markets and remove some of the perhaps unnecessary restrictions, and hopefully it'll at least cause an examination of which of those regulations need to be retained and which ones were just superfluous to begin with and actually harmed those markets. So very, very interesting. Along those lines, when I think about the overarching freedom that is under threat with regulation or excessive intervention in the marketplace, do you see that perhaps the Main Street lending program, if it's implemented properly, could be an opportunity to help those micro markets be more targeted and have local banks determine which businesses just need liquidity but are not trying to retain solvency? Do you think having that kind of a program, even though, as we mentioned before, it's outside of the ordinary apparatus of the central bank, what do you think about that, making it more of a micro-targeted policy? And I guess to go back to you, John.
So I don't think that's such a good idea. I think we have financial institutions who know their customers. Maybe they should know them better. They know where new markets are developing. That's not really been what central banks do. And I think, having control over the money supply, which is a traditional way to think about it, control over the interest rates, a new modern way to think about it, but not to get into the details of each market. It's sort of a broad-based thing, try to keep inflation under control, keep the economy stable. Those are important things that a central bank should do. But when they do too many things, yield curve control, purchasing mortgage-backed securities, in Japan, of course, they've even purchased equities. I think that's going too far, and people begin to question, why should such a central bank be independent at all? And so I think now we have to be careful of that. That's actually close to this idea of continuing economic freedom, and you don't have the central bank, a government agency, doing many things that would not normally be done by government.
Yes, interesting. I'm going to shift gears and turn to Daniel, because there's a question from the audience that goes back to some of the remarks that you made about the non-neutrality of money, and then when the central banks do intervene, they tend to go into supporting the larger big corporations and governments as opposed to other entities that really need the liquidity. And the question from the audience is this. It says, is there a risk of massive wealth transfers between different groups or classes of people with the flood of liquidity? So are we seeing wealth transfers occur because of the central bank's interventions?
Not a wealth transfer, but definitely when so many people discuss the issue of inequality, there is certainly a monetary problem that has exacerbated inequality, because if you have access to debt and to assets, you are disproportionately benefited from the actions. It doesn't mean that it is a transfer of wealth, that it is taking money from somebody, but it is true that that money creation is never neutral. Now, the risk that we find ourselves in is that something that has perverse incentives, and obviously it does, deficit spending out of control, lack of structural reforms, buying assets at almost any price, knowing that they might go up eventually. All of those things are not solved by being crazier. If monetary policy has irregularities and generates imbalances and generates perverse incentives, which it does, you don't solve it by making them even larger. You see, because the next question, or probably the subsequent discussion, would be, what central banks would have to do would be to print money Argentina style. No. You don't solve the problem of economic freedom, of the risk of inequality, of the risk of cronyism by further enhancing the risks attached to the principal and first recipient of money creation, which is government. So I think that we need to go back to what John was saying, is that ultimately what makes a society less unequal, more open, higher growth, and better job creation is precisely when the mechanisms that already exist are allowed to function appropriately in the marketplace. Is that there will be some companies that will not do well and others that will thrive. But we don't pick winners and losers from government policy, even less so from monetary policy. So I say, yes, you're absolutely right, but the solution is not to go even more into the Japanese or European central bank style, because that doesn't solve the inequality problem and creates further negatives.
No, certainly that makes a lot of sense. And in regards to the economy's fundamentals, I do have a question I'll direct to John about that. An individual has asked whether or not the pandemic that we're experiencing has effectively exposed a bubble economy that is beginning to pop, or whether or not the underlying fundamentals of the economy have been strong, and as long as we can kind of get through this pandemic, we should be able to see a return to that situation.
I'm optimistic that we'll pull out of this as long as policy remains sensible. We're getting a rebound in retail sales, for example, and if that continues. But there is danger of too much lockdown. The thing that I'm optimistic about cautiously is that this is revealing problems that were there. The K-12 education system in the U.S. Has been good for some people, not so good for others. There's a lot of disparity. And I think we're seeing that. I think the kids going to school by Zoom and video is showing more of that. Certain parts of the society have almost no broadband access. So there is we're talking about infrastructure programs for roads and bridges. Maybe there should be some focus on providing this kind of service more broadly, because it's a matter of freedom. It's a matter of having access to things which we don't have access to otherwise. So I'd like to see more of that. I think there's different ways to do it, but you can see it right now. Some of the kids in districts that are not so prepared are doing much poorly compared to others. We're going to have more of this. And I think the more that we're attuned to doing this in a way that benefits individuals by improving freedom, the better off we'll be.
Yes, I think that in many respects, and we actually had a previous panel conversation, we talked about how the technology that exists, unfortunately, is available to some but not others, and therefore maybe exacerbates these situations, makes the pandemic more severe to one group and less severe to the other. So yes, I completely agree and see where you're coming from on that, John. I have another question here that comes in and asking about what might have been learned during the Great Recession that then we are applying effectively to the actions and policies coming from central banks today. Have there been any lessons learned, or are we learning new ones along the way? How about you, Daniel? Anything that you think central banks have learned?
I think that we've learned a few things. I think that, for example, it is the fact that the Federal Reserve is being a lot more detailed about communication, I think is an important factor. We might not consider it as much in the general debate, but I think that there's been a huge improvement in terms of Federal Reserve communication, members of the Federal Reserve constantly talking to markets and to the press and giving their opinions. I think that what we've also learned is that getting out of the crisis by betting only on monetary policy does not work. We've seen that when the Eurozone launched its quantitative easing program, the vast majority of the Eurozone economies abandoned all structural reforms and continued to be in stagnation. So I think that we've learned a lot of things about the response to the crisis. I think that it's also true that this one is quite different than the 2008 crisis. This starts as a supply shock followed by the closing down, the shutdown of the economy by governments. Therefore, incentivizing demand is ludicrous because there's no demand to incentivize, and because the little demand that you will incentivize is already in overcapacity. So what I think we should learn is that you should not maximize the policy tools from the very beginning. Coming back to what John was saying, doing too much too soon ends up being a very, very dangerous thing because as what we saw, for example, again, coming back to the ECB with Mario Draghi, is that then you run out of effective tools to respond if there is a credit demand issue further down the line.
And John, you mentioned the supply shock, Daniel. John, I'm getting questions about the double whammy of stagflation. So for those who may not be aware, stagflation, a drop in output in GDP coupled with rising prices. Do you see that on the horizon, stagflationary shock?
I don't see it on the short horizon, but it's something that we should be concerned about. Actually, you look at the details like I do of so-called M1 and M2 measures of the money supply, they've increased a lot more in this episode than they did in the global financial crisis following that. But I think the lesson here are more longer term. At least you have to go back longer term. We had a good economy in the 80s and 90s. You could see policy being different. I think in the leading up to the global financial crisis, policy got off track. It stayed off track, but then it started to get back on again. And before this one is obviously not caused by monetary policy, but we may have been a little bit better off if policy had adjusted. But I think monetary policy is very important. To some extent, it's the cause of the crisis. This was not the cause of it. We hope it's not making it worse. It's making it better. But it's important to think about even those low interest rates in 2003, 4, and 5 may have been possible reasons for the search for yield and some of the bad times that occurred in 2008 and 9.
So good lessons learned. Just to let you know, we're about 2.5 minutes to our end time. So in about a minute or less, how about offering a few ideas that are, you said earlier, cautiously optimistic, I think, John. John, why don't we start with you? What is it that makes you cautiously optimistic for our future?
I think that we're learning lessons here about what to do and what not to do. If we take those into account, we'll be better off. But those lessons are more letting markets work. Observing how some of the things, including this technology we're using now, came out of the markets. Many people are more using Zoom. Facebook says that it's going to have half of its workforce online coming up. So those are the things to try to encourage more online purchases, more telemedicine, as we discussed again, and encouraging that. It could be more executive orders coming out of the White House. There could be more executive orders coming out of the states. And I think internationally, it's the same kind of thing. Let's take a lesson here about where the harm has been, and largely it's the shutdown, which has been the harm. And could we do that better next time, because it hasn't worked out so well this time.
Terrific. Thank you, John. How about you, Daniel? Any optimistic reasons for hope here?
I think that there are reasons to be optimistic. We see, for example, the very rapid and strong bounce in retail sales. All these figures that we're seeing they make you be cautiously optimistic about a recovery. I think that the main reasons to be optimistic about the US recovery come from the fact that it's an economy that is not so dependent on bank financing. The real economy in the United States is less than 20% financed by the banking system, whilst, for example, in the Eurozone or in Japan, it's about 85%. I think that makes the recovery quicker. I think that also it's an entrepreneurial society. You just mentioned the example of what your wife has done, but you hear it all the time in the United States, how people are trying to adapt very, very quickly to the changing environment and to the new paradigm. And I think that the other element is that the economy, coming back to what John was saying, I think it's an important difference. The economy was very strong before, and was very strong with something that was not happening either in Europe or Japan, which is productivity growth. We saw productivity and wage growth in an environment of low unemployment, and improving investment. So those things can actually come back quite quickly, because the innovation, the capital, and the industrial fabric of the country remain. I'm less optimistic about the recovery of economies that already in 2019 were seeing weakness. The Eurozone, Japan itself, the fourth quarter was very evident. So that's I think it's going to be a tale of two recoveries. I think that the United States will recover faster, and emerging markets, Eurozone, much slower.
Well, this has been a fabulous conversation, and I share your cautious optimism and hope that at least unnecessary regulations will be exposed and will accelerate some of the progress in facilitating markets that wouldn't otherwise exist. So thank you so much for spending time with us. We very much appreciate your expertise and sharing it with our audience. So thank you. And thank you all for joining us as well. And stay tuned for just a few minutes as we will get ready to see our last main stage event with Father Robert Sirico. Greetings to you again, wherever you may be across the globe. You know, I feel like the past 2 days have opened my eyes to new ideas and have reminded me how important it is to engage in lifelong learning devoted to the pursuit of truth. I am convinced that a free and virtuous society is essential for promoting the common good. And we can't sit back and assume such a society is inevitable. Promoting freedom and virtue takes dedicated effort. One individual who has demonstrated a life dedicated to promoting freedom and virtue is the Reverend Robert Sirico. President and co-founder of the Acton Institute, Father Robert has been indefatigable in educating others on how both freedom and virtue go hand in hand. Each one is essential to fostering and maintaining the other. And so I am delighted that he is our closing speaker for our first ever Acton University Online. Following Father Robert's talk, Eric Cohn will join him in studio for a final question and answer session. So join us in just a few minutes as we reconvene at 1 o'clock.